Hey guys, myself CA Srinivas, my dear junior CAs. Today we are going to start a beautiful accounting standard in CA Inter Advanced Accounts, which is Accounting Standard 10, Property, Plant and Equipment. So the beauty of this standard is this basically sets up the entire principles of asset accounting across all the standards. This is little vast and obviously very important from an examination angle. Even in terms of MCQs also, questions can be expected out of it. So let's see how this beautiful standard unfolds first. Okay, now let's start with the definition of property, plant and equipment. Now, you might have heard about a term called as fixed assets. The term fixed assets basically means tangible assets as well as intangible assets. Now, under the accounting standards framework, we have a separate standard for intangible assets, which is AS 26. Now, this is accounting standard 10, which is titled as property, plant and equipment, and this covers only tangible items. Only tangible items are called as PPE. Intangible items are recognized as a separate intangible asset under AS 26. Now let's see the definition. Property, plant and equipment is a tangible item of asset held for usage. The most important term here is held for usage. Sir, how can I use this? You can use it in 4 ways. For production of goods. For example, you are having plant and machinery. Plant and machinery is used for production of goods. So that is one utility. Case 2, rendering of services. Now we are having this huge camera here, we are having this projector, we are having mic setup, there is lot of furniture for all you students. So these are assets which I am using for providing services to my customers. So for rendering of services, for administrative purposes, for example, to maintain all my accounting, I need like a computerized accounting. For that I have a dedicated accountant who is doing all the accounting in computer. So the computer is used for maintaining records. For record keeping, we are using a hardware computer. So that is used for administrative purposes. Next, on giving on rentals to others. So for example, you are having 10 cars. These 10 cars, what are you doing? You are leasing it to, you are giving it a rent to people who are driving cars under Ola, Uber and all. So you are using your asset to give it on rent to others. So for these 4 purposes, if you are holding an asset for the purpose of using in these 4 categories, then it is called as a property, plant and equipment, provided it must be capital expenditure. That means the life of the asset, it should be more than 12 months. So it's expected to be used for more than 12 months is another criteria. So total we have seen 3 criteria here. So one is it should be a tangible item of asset. Number 2, it should be held for usage, and it should be held for usage in any of these 4 purposes. And finally, it should be a capex. It should have a utility more than 12 months period. Then you become a property, plant and equipment. Now, there is some 1 or 2 points relating to scope, agricultural activity and all. We will talk about that towards the end of the chapter. Straight away, let's come to the most important part, which is called as the recognition criteria. For that matter, you take any asset, sir, any asset standard, recognition criteria will be same. First of all, what is the meaning of recognition of PPE? Now, what is the meaning of recognition criteria? Now, it's a simple point, guys. So, for example, if I ask you, when you buy an asset, let's say you purchase a plant and machinery, what is the entry you write? You write an entry like plant and machinery account debit to bank. By writing this entry, you are opening an account of plant, correct? A plant and machinery account you are opening. This opening an account relating to PPE is called as recognition. Recognition criteria means there are some conditions. If you fulfill these 2 conditions, then only entry you can write. Plant account debit to bank entry, if you write, you are recognizing plant as an asset in your books of accounts. So that recognition you can do when 2 conditions are satisfied. Condition number 1, it must be probable that the future economic benefits associated with the asset will flow to the entity. That means, see, asset is supposed to give you some benefits. You should have a belief that those benefits will be enjoyed by the entity. Those benefits will be consumed by the entity. That feeling you should have. Number 2, cost must be measured reliably. What's the meaning of this? See, sir, if I have to write an entry, I cannot write a blank entry, isn't it? I have to write the entry with an amount. And in the standard further, you will understand that all the initial recognition principles say that asset acquired must be recognized at cost initially. So if you do not know the cost of the asset, how will you write the entry? So obviously I should know the cost also. So how many conditions are there? We must have a belief that future economic benefits associated with the asset will flow to the entity, number one. Number two, cost must be measured reliably. These are the two conditions. Now, having said that, now what is the meaning of future economic benefit? Future economic benefit means in future either there should be a increase in your revenue or there should be a decrease in your cost or both, and ultimately it must result into increase in your cash and cash equivalents. So for example, if you buy a machinery, I'm able to manufacture goods and sell them, that will increase my revenue. I buy another kind of equipment, that will reduce my existing cost of production. My existing machinery is there, but under the new machinery the cost of production is going to become lower, so reduction in cost. So either increase in revenue or reduction in cost, they both are capable of giving you increase in cash and cash equivalents in future. That is called as future economic benefits. Then a standard also says future economic benefits can be direct benefits or it could be even indirect benefits. Now, what is the meaning of direct benefit and indirect benefit? Direct benefit means, simple example, a plant and machinery which is manufacturing goods. So, plant and machinery is used for production of goods which I am going to sell it off and make money out of that. So, that's a very clearly direct benefit. I am using a laptop, iPad and all for delivering my classes. So, for rendering of services, I am using some equipment. Very straightforward, direct benefit. Now, coming to an indirect benefit example. Suppose, sir, I have a production line. Production line means machine A, machine B, machine C. Machine A ka output will become input to B, B ka output will become input to C, like that, and C ka final output will be the finished product. Now I am using three assets, A, B, C and ABC, three assets. Now in the process of production, there is some toxic waste that is getting released, which is nothing but the scrap. Now this scrap I have to dispose it of properly. If I go and throw this toxic material anywhere, people can get hurt. So what I did, lot of waste is getting generated. So what I did, I imported a machine called D. This D machine ka job is, as the name indicates D, it will detox the scrap. And once the toxins are removed from the scrap normally I can throw off anywhere I want. Now, am I using D for the purpose of production of goods? No, D is not producing any goods. D is not giving me any services directly. But what is the indirect benefit it is giving is, it is helping me to run A, B and C perfectly, and finished goods I am able to sell it. Because if D is not there, it toxic material, I don't know how to dispose it. If I go and dispose it of somewhere, people will come and ban my business. So there is a risk of my business shutdown if D is not there. So what is D doing to me? D is giving me an indirect benefit. Because the D is there, I can happily use A, B and C. This is called as an indirect benefit. Another example of indirect benefit is, so for example, let's say we are in an education institution. To pick up all the school kids and the teachers from their houses and again dropping after the school to their places, I need buses. Let's say I have 4 buses. 4 buses are sufficient for my level of the school. Now what I did is, when exactly 4 buses are sufficient, I don't buy 4 buses. I need one more extra bus, spare bus, insurance bus, one extra bus. Total 5 buses I have. 4 buses daily will be running, sir. 1 bus is a backup bus. Okay, now it so happened that throughout the year, none of these 4 buses gave any problem. So since there was no breakdown and all, whatever insurance spare bus we have reserved it, that bus I never put to use. Does it mean that a 4th or 5th bus, it did not give any benefit? No. Even the 5th bus was capable of giving benefit, and that is not supposed to be used on a daily basis. That is going to come to your rescue when any of the existing assets are not functioning well. When any of the buses break down, then this fellow will go and help. So is it ready for help? That's all. Because that 5th bus is giving me a peace of mind, I am able to run these 4 buses peacefully. Similarly, another similar example is, we have this power backup generator, inverters and all. So if there is a power cut, I can still run my class because there is a generator. But what if throughout the year there was never any power cut? Since there was never any power cut, a generator set I never used at all in the current year. Does it mean that a generator did not give any benefit? No, generator gave a benefit. Even that's the reason, even on Sunday afternoon also, where usually power cut will happen, even on that time also I have conducted my class, trusting the generator. Of course, there was no power cut, I did not use it, but it was capable of giving benefit. A capability to give a backup to you is the indirect benefit what the asset is providing. That's what it is supposed to give me. So that benefit I'm getting. So benefits can be direct, benefits can be indirect as well. Next, most important point. See, A, B are over in the notes. Coming to C point. Spare parts and standby equipment. Standby equipment is his backup asset, sir. Spare part. Now, suppose, sir, you bought a machine. A machine life maybe 20 years or 10 years. In that one part is there whose life is only 2 years. So what you have done after 2 years, again you have to replace the part. So why to take risk? What he did at the time of buying the machine, only 2 spare parts extra I purchased. Now, a spare part, whatever you have extra purchased, how should I treat it? Should I treat it like PP or should I treat it like any other asset? Now, what the standard says is, go and check a spare part, does it satisfy the definition of PP? That means, see sir, since machinery is used for production of goods, a spare part also indirectly is used for production of goods only. So, a point is satisfied. It is visible, you can feel, touch it, so tangible. So, only thing I have to ask now is its life more than 12 months or not? If its life is more than 12 months, then definitely you can treat that spare part as a PPE. Spare part will become a PPE provided it has a useful life of more than 12 months. So, what if its life is less than 12 months? If it is just less than 12 months, in that case, you will treat it as inventory. Now, there is a standard called as AS2. Under that standard, we will learn that inventories which are in the nature of stores, spares and all, whenever they are consumed, they are booked as an expenditure in your P&L account. So, whenever they are consumed, at that time you will put it in your P&L account. Otherwise, if its life is more than 12 months, then you will treat it as a PP. So, that sums up our definition criteria of PP. That sums up our recognition criteria of PP. Now, going further, the most important part is initial measurement. Initial measurement means first time when you write an entry, asset must be debited with what value. Now, this discussion, according to AS10 and to our based on our study material also, we will discuss this in 4 categories, sir. Number 1, a ready-made asset purchased for cash or credit. First case means asset is ready, you just have to take and install it. Payment, either you have done it right now or you have agreed to pay it at a later date. Asset is ready-made. First case. Second case, self-constructed asset. It means asset is not there, you are building it. Number 3, a PP acquired by way of exchange. You gave away some assets, in return you got a PP. You might have paid some cash, you might have received some cash, that is also possible, but broadly, entire consideration is not cash. You have given away some assets and acquired a PP. Third case. Fourth case, some special cases are there, nothing to worry, easy only. Now, let's focus on the first one. When PP is purchased for cash or credit. Okay, so when PP is purchased for cash or credit, let's take an example. Let's say our factory is in Hyderabad. The machinery is there with some manufacturer in Jaipur. I went there, I negotiated the price. Now, imagine that fellow quoted 55 lakhs. 55 lakhs is the quoted price. I told him that, see, I'm a major customer, I'll be having some more requirements and all. I somehow bargained it. That fellow gave a trade discount. A trade discount of 5 lakhs. Since you need not pay this, this is never your cost anyway. So 50 lakhs. Then he says, sorry, I am charging 50 lakhs, sir, but you have to pay GST also. So let's say GST is another 8 lakhs. Now, 8 lakhs, should it be treated as part of the cost of the asset or not? The answer is, it depends. Now, you have to check whether it is refundable or non-refundable. Now, what is the meaning of refundable? For example, sir, you all know, under your indirect taxes, you can take credit for the input GST. Okay, input tax credit will be there. So, if you pay 8 lakhs also, 8 lakhs indirectly you can recover it from your customers. So, if it is that kind of thing, then it is refundable. If it is refundable, do not include. If it is non-refundable, then you can include. That means you are not getting any input GST credit, or assume that whatever tax you are paying is not GST, it's something like a customs duty on import of machinery. Customs duty, nobody will give you any credit for that. So, whatever you have paid, that's cost only. Now, here I am paying 8 lakhs. Definitely it's my cash outflow, but is it my cost or not, you have to check. If it is refundable, then even though it's an outflow, futurely you will get it back again. So, it is not your cost. But if it is non-refundable, then it is not only an outflow, it is also your cost. So I am assuming that this is non-refundable, so I am including it. If it is refundable, you are not supposed to include it. So if refundable, do not include, otherwise you can include. Then okay sir, tax is also paid. What next? Now the machinery is there still in Jaipur, it has to come to my factory. So what all costs I have to incur? I have to incur transport cost. Now the question is, sir, how will you transport this? I have to put it on some carrier vehicle. So for that, loading charges, transportation cost, and throughout the transit period, if any accident happens, a risk is there. So I am taking transit insurance also. Then after the vehicle reaches our location, I have to unload it. Now all this in general reality we call it as delivery and handling charges. This delivery and handling charges, you have to add it to the cost of the asset, because if you do not incur this, your asset won't come to your place in the first place. So let's say that is some 6 lakh rupees we are incurring. So 64 lakhs is the cost till now. Now that this asset reached my location, I got to install this asset so that I can use it. Now if I have to install, first of all, I have to create a special foundation there. So that is called as a site preparation cost. Let's say that is some 2 lakh rupees, capitalize that, add that also. Then the proper installation charges. The asset what we have purchased, we have to install in this foundation with the help of some people, labor people we use, and they will install this. That labor services, whatever amount you are paying, that also you have to capitalize. So let us say that is some 4 lakh rupees. Now throughout the period of installation, sometimes certain assets are very complicated. The normal labor people, they cannot come and install it. They need some supervision. So I appointed some consultant. So he will charge some fees, technical supervision charges. So let us say that is some 5 lakh rupees. Add this also. So if you see here, by now the total amount I have capitalized to the cost of the asset, the cost of the PP is 75 lakh rupees. Till now we have capitalized that much. Now I have to see whether the asset is working or not. So that is called as a trial run expenses. Trial run expenses basically is the testing phase, whether the asset is properly working or not. So trial run expenses ka purpose is okay, but what exactly are you spending there? What am I spending here is, I have to input some raw material, I have to incur certain labor cost for this, I might have to incur certain overheads for this. Let's say all this put together is 3 lakhs. Okay. Now what is the objective? The objective is I'll input some material, I'll incur some labor cost, I'll use this asset, see whether the output is in the expected quality, quantity, all the ticks are satisfied or not. Now output came, that output this fellow sold, minus inflow from sale of output in trial run. This he sold off. So let's say he got 2 lakh rupees from the sale of it. So your net testing cost is only 1 lakh rupees. That only you have to add. Very important, sir, be careful. So that's about your trial run expenses. Next, you may have to capitalize borrowing costs also if the asset is a qualifying asset in accordance with AS 16. Now usually for a ready-made asset, this the very less chance of this being there, but more story we will talk about this when we go to another standard called as AS 16. Time being, just understand a small background that to buy this asset you need money. That money you sourced it from a borrowing. On that borrowing you have to pay interest. That interest cost can be added to the cost of this asset, provided this asset is a qualifying asset. Now what is a qualifying asset? Qualifying asset is an asset which necessarily takes substantial period of time to get ready for its intended usage or sale. So this concept we will study separately in AS16, sir. So all this we have capitalized, fantastic, sir. Now finally last one fellow is there. This is present value of decommissioning and restoration expenses. Now what is this? We'll come up with an example and then we'll come back and fill it up. Okay, now watch the example closely. Very easy example. Let's say 0, 1, 2, 3. 0 is today, sir. 1 is end of first year, 2 is end of second year, third year ending timeline. Today I purchased a plant and machinery. So entry I wrote is plant and machinery account debit to bank with an amount of 5 lakhs. Now I incurred some installation expenses also of, let's say, 1 lakh rupees. So installation expenses also has to be capitalized. So plant and machinery account debit to bank 1 lakh, 1 lakh. This is for installation expenses. Now here one small issue has come up. Now if I have to install this plant and machinery, this building, some walls have to be broken. Fine sir, break it off. It's not my own building. I am operating this entire business in a rented building. So if I have to install plant and machinery which requires certain walls and all to be replaced or some modifications has to be done to the structure of the building, then I need to take an approval from the owner of the building. So I went to the owner. Owner sir, I will break your building and I am going to install this plant and machinery, and after 3 years my plant and machinery life will be over. At that time I will remove the plant and machinery from your building and I will incur expenses to restore the building to its original shape. This is the commitment you have given to the owner. Owner said fine, but compulsorily after 3 years you have to remove it. So we have agreed to that. Now the problem here is, by breaking the wall and installing the asset today, you have brought upon yourself an obligation to incur some expenditure after 3 years to remove the asset and restore the entire building back to the original shape. Did you make a promise or not to the lessor or to the owner of the building? Yes, we did. So what this standard says, stand today and estimate that at the end of third year, how much expenditure are you going to incur? Go and estimate. Let us say you are saying that after 10 years, sorry, after 3 years, you are going to incur an amount of 10,000 rupees just for convenience. So by installing the asset today, you have brought upon yourself an obligation to incur an amount of 10,000 rupees after 3 years. What this standard says is, no problem, 10,000 rupees discounted to today. Discounted to today. Sir, what discounting rate I should use? Your borrowing rate you should use, because you are, it's like I'm promising to pay some money to somebody at a later date. It is like that. So imagine my discounting rate is 10%. So 10,000 rupees into PVIF 10% third period. 10,000 into, I hope you understand how to compute PV factor. If you do not, 1 divided by 1.10 is equal to. So that will be equal to 10,000 into 0.75131, which is 7513. So what is this 7513? 7513 is present value of, this is present value of decommissioning and restoration expenses which you are going to incur after 3 years. Now, since you have an obligation to incur, it is not simply an expected cash flow alone, it is an obligation to compulsorily have to incur this. So the standard says, read with some of the standard called as AS29 provisions, it says on the very first day itself, create a provision for decommission. one liability you have to create. With what value? 7513. Later on, when we do so many standards, you'll realize later on that all the provisions are usually created by debiting P&L account. But this decommissioning provision is an exception. This has to be debited directly to the PP itself. Here our PP is plant. So plant you have to debit with an amount of 7513. So your plant basically, plant's initial recognition 5 lakhs is the cost of the asset. 1 lakh rupees is the installation cost plus 7513. 6 lakh 7,513. 7513, this is your PV of decommissioning liability. This also will be part of your asset. Why am I showing you this picture is, now hereafter when you have to charge depreciation, this is the amount which you have to depreciate. Now you see, observe here, we all have seen so many items which are going into the cost of the asset, correct? So many items are going into the cost of the asset. Now, along with so many items which you are spending today, even this present value of future cash flow also has to be added to the cost of the asset. Now, let's see a little bit of further accounting. At the end of each year, year 1, year 2, year 3. Now, observe here. On the very first day, what you have done, 7513 rupees liability you have recognized. This 7513 liability, even though you have recognized today, but the expected payment is not 7513. The expected payment after 3 years is how much, guys? That is 10,000 rupees. But you recognize only a liability of 7513. How is it this 7513 going to become 10,000 rupees? For that, what you have to do is, you have to do some dummy accounting sets. Very important stuff. This is called as interest expense account debit to provision for decommissioning liability. Every year you will record this dummy entry, and this interest expense you will transfer it to your P&L account. Now, every year what amount you should write the entry. Now, your liability originally recognized as 7513. Your discounting rate was 10%. Now, apply the same 10%. So, that will be now 751. I'm leaving a couple of lines here, and then I'm writing closing balance of provision. The closing balance of provision now will be 8264. Why 8264? Already on day 1 I recognized 7513. Here, end of first year, on the balance sheet date, I recognized 751 expense and also a liability. That liability will increase my original to 8264. So second year, the 8264 into 10%. So that will be 826. Because of this, my liability will now become 9090. In the third year, 9090 into 10%. That's 909. I'm writing it as 9 tensor. Small rounding of error will be there whenever you use PV factors. So now the closing balance of the provision 9090 plus 910, it will be exactly equal to 10,000 rupees. But third year ending, I'm actually going to incur this expenditure of 10,000 rupees to remove the asset now. So what I will do now, I will write another entry. Provision for decommissioning liability account debit to bank. First year, second year will not incur this. Directly I'm incurring this at the end of third year. So 10,000. The moment I incur this, the balance will become 0. This has got nothing to do with your PP accounting. What is this? Liability accounting. Sir, why are you discussing this here? There is another standard AS29. At the time we'll discuss again. But this is a liability which is related to PPE. That is the reason I'm just finishing up the entire picture. Now, the entire process of you initially recognizing this at present value and every year booking a artificial interest expense and increasing the liability. Slowly, your 7513 became 8264, became 9090, become ultimately 10,000 rupees. The entire process is called as unwinding of discount. Sir, what is this name? We do not like it. See whether you like it or not. Discounting means what? Converting a future value into present value. Where at 10,000 I converted into 7513. Reversal of discounting is called as unwinding of discounting. That is nothing but basic overaction done for compounding. They could have called it as compounding directly, but anyway. So this is the terminology, sir. So, sir, with that, we kind of have finished what are all the expenses that will go into the initial recognition of the asset when the asset is a ready-made asset acquired for cash or credit. On this, at least some 3 or 4 questions are there which are exam worthy. We will see that in a while, sir. So this is done for us. Next, a decommissioning expenses, history and all I have explained already to you. Directly attributable expenses. Okay, we all understand that directly attributable expenses can be capitalized. That's the reason you capitalize installation charges. That's the reason you capitalize site preparation costs. That's the reason you capitalize delivery and handling charges. That's the reason you capitalize trial run expenses. Okay, so that's obvious. Now, I'm telling you outrightly, do not include. If you find any of these 6 items anywhere in any question, if they ask you, should I capitalize this into the cost of the asset? Blindly remember this, answer is no. Reasons will automatically come. First one, cost of opening new facility. Now you see guys, last 2 years you are trying to set up a factory in our capital. Okay, so what you have done, you hired a building, then you purchased various kind of machinery, you hired the right people. Now at one day everything is set ready. From tomorrow onwards you are going for full range production. Today what you have done, since tomorrow onwards we are anyway starting production, today you have given a huge inaugural party. You have called all your suppliers, you have called all your prospective customers, you have called your competitors. You want the market to know that you have arrived, correct? So for that you have launched a huge party. The party expenses cannot be capitalized to the cost of these PPEs. That's wrong. Sir, why, sir? Because I'm going to use this PPE, that's the reason I'm giving a party. But just because you're giving a party, does it mean that your future economic benefits will increase? Is there a probability of you having higher benefits, higher sales in the future just because today you throw a party? It's not probable. That's the reason you cannot capitalize. Number one. Number two, heavy advertisement expenses cannot be capitalized. For example, when IKEA was setting up their unit in Hyderabad, 6 months before onwards, the entire city was full of IKEA hoardings. So just because you do heavy marketing, you're trying to catch the public attention, but does it mean that sales will happen because of the ad expenses what you're incurring? Not likely. That's the reason heavy advertisement expenses cannot be capitalized. Number two. Number three, admin and general overheads, security guard, okay, accountant salary, marketing fees, all these costs cannot be capitalized. They have got nothing to do with generation of revenue from your assets. So you cannot capitalize that. Next, suppose, sir, I am having suppose, sir, I am having 1, 2, 3, 4 floors I am having. Now, I am trying to construct another 5th floor. While I am constructing this 5th floor, there is a lot of disturbance. Obviously, construction work is not very pleasant to hear and also it's disturbing. So what I have done, since my employees are not having a peaceful work environment here, what I have done, for the next 6 months, I have hired another building. And all this from here to here, I have relocated. That made me incur something called as relocation costs for next 6 months. So for bringing all these people here to new building, paying the rent of this new building for a period of 6 months, informing all my customers that we have temporarily been shifted to so and so place for all this advertisement publicity cost. And after 6 months, once the 5th floor is completed, we again incurred expenses to relocate to our original building. The question is, can all these relocation expenses, why are they incurring? Why are we incurring? Apparently, it looks like we are incurring this relocation cost because we are constructing an additional floor on our existing building. True. But what the standard says is, just because you incur relocation expenses, relocation expenses cannot be capitalized to the cost of the asset for the simple reason that, did the 5th floor say that if these people are sitting and working here, I will not get constructed? No. You could have still constructed 5th floor even though these people are sitting and working there. The reason for moving from there to here is you wanted to provide your employees with peaceful work environment. So for that is the reason you have incurred some money and relocated from this building to another building. So this has got nothing to do with construction of fifth floor. This expenditure will not increase the efficiency, or it will not increase the quantum of future economic benefits that you are going to get from floor 5. That's the reason this cannot be capitalized. This will be transferred to P&L account. Don't add this to the cost of the asset. Next, another example. Let's say sir, I imported some machine from Korea. Now, our employees do not know how to operate this asset. So what I have done, I have got two people from Korea who are providing training to our employees on how to use the asset. How to use the asset. These employees will give training to, sorry, these consultants will give training to our employees. Okay, fine. Our employees are trained now. They are super capable of how to operate the asset. Now, the training costs I have paid is 15 lakh rupees. Question is very simple, sir. This one, can it be capitalized? The answer is no. This will be transferred to P&L account. Sir, it is a necessary cost, correct? If you do not incur this, my employee will not be able to operate the asset. True. That's the reason we are incurring. Every expenditure is necessary only. Otherwise, why will anybody incur any expenditure if it is unnecessary? Of course, it is necessary. Then why can't you capitalize it to the cost of the asset? Simple, sir. You bought a car. You do not know how to use the car. So you joined a driving school. And you learned how to drive the car. So whatever fees you paid for learning how to drive a car, can you add it to the cost of the car? Can you say that this is also part of the cost of the car? No. The reason, whether you learn driving or not, the asset is already capable of giving the benefits what it is supposed to give you. It is by learning how to drive a car or by taking training on how to operate this asset, what has improved? The skill of the employee has improved. The skill of you has improved because of you learned how to drive a car. But car efficiency, car capability is not getting increased. That is the reason you cannot capitalize training cost to the cost of the asset. I hope that is clear. Next one. Sir, imagine I have constructed a factory with lot of assets in that. Now, my factory capacity is to produce 1 lakh units per month. This is the capacity. Just because you are having a 1 lakh units production plant in each month, means every month you can produce 1 lakh units in a production plant, does it mean that on the day you start your business, first day onwards you'll start producing 1 lakh units? It's not like you can't produce, you can, but orders must be there. No, customers should come to you. No, so it will take time for you to hit the market. So people also should trust you. It will take some time. You have to beat your competitor and you have to capture the market. Till then, you will not be operating at 1 lakh units. So this is your max capacity, agreed, but initially operating at 40,000 units per month. I'm having capability of 1 lakh, but I'm producing only 40,000. So even though you are producing only 40,000, you still have to pay rent for the entire factory, which is capable of 1 lakh units. You still have to have so many employees who can help you to manufacture 1 lakh units. So 40,000 units you are manufacturing because sales are less. And it is no surprise. Initially, everybody will have lower sales only. So initially, you are suffering losses. A loss cannot be capitalized. Very, very popular question. Initial operating losses, since it is very normal and normal losses we can add it as a cost, the answer is no. This standard does not permit you to capitalize losses to the asset. No fool will allow you to capitalize loss to an asset. Loss means what, sir? Money already lost. Asset means what? Future economic benefits. Future money will come, that only you can capitalize. What is already lost, how can I add it to the cost of the asset? So initial operating losses cannot be capitalized. So point number 1, point number 2, point number 3, relocation explained, training cost we have discussed. Initial operating losses also cannot be capitalized. So guys, with this we have finished one segment of initial measurement of PP, which is a ready-made asset acquired for cash or credit. Next, let's come to self-constructed assets. Now, what is the meaning of a self-constructed asset? Visualize it this, sir. You are constructing a building on your own. You're not buying a building, you are constructing a building. This is your own land where you are constructing a building. Okay, now, and you are basically a cement factory also. Your main business is this. And you are constructing another building in your vicinity. Now, in this self-constructed PP, what all expenses shall I capitalize? Remember the rule very clearly, guys. You have to capitalize only actual costs of material, labor, and overheads. Only actual costs, no notional costs, no notional profits. You cannot capitalize. Sir, what is the meaning of notional costs? Sir, material, labor, overheads are anyway I have to incur, I'll capitalize. That's very easy. What is the meaning of notional cost? Notional cost is, listen, sir. Now, for this I need 1000 bags of cement. What will I do? I go to the market and buy cement and come on. No, because I myself am a cement manufacturing company. So what will I do? I will take from my godown and I'll use it. So what I would have done from our cement factory, I would have taken 1000 bags of cement. Now the question is, if 1000 bags ka cost is rupees 400 per bag, but market price is 600 rupees per bag. That means, had you bought the cement outside, your cost would have been 6 lakhs. But now that you lifted this stock from your godown and you are using it for construction of building, your effective cost actually is coming to only 4 lakhs. Now to the cost of the building, how much should I add? Should I add 4 lakhs or should I add 6 lakhs? That is the question. Again, to reiterate, the wording is this. You have to use only actual cost. What is the actual cost of 1000 bags? The actual cost of 1000 bags is only 400 rupees per bag. So you can capitalize only 4 lakhs. Is 600 rupees per bag is wrong. Actual cost only must be capitalized. Only 4 lakhs, nothing more. Right? This is one point. Second, now that you are constructing an asset, the construction of an asset might take time. Therefore, it becomes a qualifying asset, and therefore, borrowing costs may be capitalized. You can capitalize borrowing costs actually, because most probably it may be classified as a qualifying asset. Sir, who will qualify me, sir? Who will decide whether I am qualifying asset or not? Another standard, AS16. Most probably we will discuss it immediately after the standard gets over. If that standard permits, you become a qualifying asset. And to construct this particular building, if you have made any borrowings, the interest cost what you are incurring for that borrowings, that interest cost can be added to the cost of the asset. That's the whole idea. Next, depreciation of other assets that are used in construction of PP. So for example, throughout the current year I am constructing this building, sir. Okay. Now for construction of this building, I needed a crane. I already have a crane. So I used that crane for the purpose of this building construction for a period of 6 months. Now what this standard says is, a building is a PP under construction, okay, put it aside. That crane also is a PP, no? Since crane is also a PP, on that crane we have to provide a depreciation expense in the P&L account for the entire year. In that entire year, 12 months depreciation, for 6 months, a crane is used for the purpose of construction of this building. So 6 months depreciation should not go to P&L account. It should be treated as a cost of construction of this building. Another 6 months depreciation, that is you throw it off into P&L account. I don't have a problem. So depreciation of other PP which is used in construction of this PP must be capitalized to this PP. That is that. Next one. Abnormal losses cannot be capitalized. What is the meaning of abnormal losses cannot be capitalized? Simple, sir. I purchased some 5 lakhs worth of material. Okay. Now, I'm using the material cement and all whenever I want, I'm using. Suddenly, what I found is some of the material is spoiled. So I spent money on it. It's my cost only, but I can't use it because it is damaged. So I simply have to throw it off. So loss. You spent money, but it cannot be converted into a PP because a material is damaged material. It is a loss. So we cannot capitalize that to the cost of the asset. Similarly, I constructed ground floor, basement roof is done. First floor I am constructing, sir. When I am constructing first floor, this ground floor is shaking. Then I understood that something is wrong. Then on investigation, I identified that the design based on which I did this entire construction, in the design there is a flaw. Now that there is a flaw in the design, whatever expenditure I incurred till now on this particular asset, that's a waste. Last 15 days, I incurred so much of material cost, labor cost, overhead cost. All this is waste because your fundamental design is wrong. So what I have to do now? I'll anyway construct second floor. No, I'll sit and demolish entire first floor. Whatever ground floor I have constructed, I demolished it completely. The process I suffered a loss of 6 lakh rupees. Cannot capitalize. Throw it up into P&L account. Abnormal losses cannot enter into your cost of the asset. For that matter, no loss can enter into your cost of the asset. So this is about that. Next, another point. Sir, while constructing this, I got some scrap. A scrap I sold off, money came in. Can be deducted from cost of PP. Because I'm constructing this PP only, a scrap came out. A scrap I sold. So a inflow is treated as a reduction of the cost of construction. So that's how you have to minus it. Next important one. Parking rent received during construction period do not deduct from cost of PP. What is this? Watch this example, sir. In the above thing you see, you are building, you are constructing, okay. Throughout that building, there is some area, there is some land here. As you are constructing, somebody comes and says, sir, since your building is going to take some time, in this land we will park our vehicles, sir. We will pay you some monthly rent. So like that, I allowed somebody to use my land to park their vehicles and I collected some rental income. So that rental income, whatever you are getting, can I reduce it from the cost of the asset? Standard says no, don't do that. Reason, you are not getting rental income because you are constructing. Nobody will come and say, sir, we want to park our vehicles here because you are constructing. We like that cement smell and all that cement, sand, bricks, all should fall over on vehicles. That is the reason we are parking our vehicles here. Will anybody say that? So you constructing the building is not the reason why you are earning parking income. Even if you do not construct the building also, if somebody wants the land for parking, they would have asked you anyway. So you earning rental income throughout the period of construction is not directly or indirectly related to your construction work. So this has to go as income in your P&L account and not as a reduction from the cost of the asset. So that is about self-constructed assets, guys. So sir, we have finished off two categories now. One is ready-made asset, one is self-constructed asset. In note point also I have covered. One is rental income, one is scrap. Self-constructed asset ka point is over. The most important one among all the three categories, four categories, this is little typical, but this is not difficult also, it's very simple. It is about a PP acquired exchange of another asset. So I purchased a PP, in return I have given some other asset. I might have paid some cash also, I might not have paid. It's like, that cash is actually referred as boot. Without boot, with boot. But with cash, without cash, like that. Anyway, now let's see how to identify or how to account a PP which is acquired in an exchange of an asset. So let's try one small example. So let's say, sir, I am having one asset. This is asset B. This asset B I have given up. In return, I have acquired PPA. Now you must understand very clearly, since we are studying PP standard AS10, we are bothered about accounting of PP basically. That means that the asset what you are acquiring must be PP. The asset what you are giving up may be PP, may not be PP, doesn't matter. Okay, now carrying amount. Carrying amount is 10,000. What is the meaning of carrying amount? Is book value. In our books, asset B is appearing at 10,000 rupees. Now, fair value. Fair value means, had I sold B in the open market, how much money will you get? You did not do it, you exchanged it, but if you sell it, you can get 12,000 rupees. Similarly, the asset what I have acquired, PPA, its market value is 13,500, or let's say just 13,000. Now, the entire drama here is only about A, sir. How to recognize A? A must be accounted at what value? For B, there is nothing to account. There is no recognition of B. Rather, there is a de-recognition of B. B is already there in my books. I have to simply cancel B. So, B account will be closed. A will be recognized. A, when I am recognizing, A must be recognized at what value? So, that's the whole discussion here. Now, the answer entirely depends on whether the transaction has commercial substance or the transaction lacks commercial substance. Sir, what is this new term suddenly? What is this commercial substance? Simple, sir. The name sounds fancy and all, but it's very simple. Very easy, sir. Just think like this. Machine B or asset B you have given up. Imagine you have not given up asset B. So then asset B would be with us only. Then I'll be using asset B. So if I'm using asset B, I'll be getting some cash flows in future. Some future economic benefits will come to us, correct? Had I continued with B. Okay, keep it aside. Now, B is given up. A is acquired. Now, hereafter I'll be using actually A. A is capable of giving me some cash flows. There is some pattern of cash flows. Now, the cash flows what you are going to earn from A should be significantly different from the cash flows what you would have earned had you continued with B. That means indirectly, more crudely if I should say, the cash flows from A should be significantly different from cash flows of B. If A and B cash flows are significantly different, then commercial substance is existing. That means cash flows from PP acquired is different from cash flows of asset given up. Sir, why are you bothered about cash flows and all? I'll tell you, very simple. Now, examples. What I have given up is a plant and machinery. Let's say B is plant and machinery. A, whatever I'm acquiring, is land and building. So one is plant and machinery, the other one is land and building. The assets are of similar nature or dissimilar nature? Absolutely dissimilar nature. Since assets are dissimilar in nature, it's highly likely that the transaction has got a commercial substance, because the cash flows what you earn from land and building, the cash flows what you will get from plant and machinery will obviously be different. That is the reason commercial substance exists. So whenever the assets are dissimilar, by default commercial substance exists. Now let us put another example. Let's say B and A, they both are machineries only. I gave up one machine, I acquired another machine. Sir, both are same type of machines, both are machineries only, no. So commercial substance is not there. The cash flows from A, cash flows from B will be same only, sir. Therefore, transaction does not have commercial substance. Can I conclude like that? No. No, we can't conclude like that. Why we cannot conclude like that, I'll tell you. Suppose, sir, the machinery what you have given up, B, is manufacturing some goods which are of one type. Machine B, machine A, what you have acquired, is also manufacturing goods, but it's completely some other unrelated goods. So A and B both are manufacturing plants only, but they produce completely different products. Since the products are different, their sale values, cash flows and all will be different. Just because both are machineries, you cannot conclude that transaction does not have a commercial substance. Okay, point number one. Point number two, another example. Let's say B and A both manufacture same kind of product. Whatever product machine B gives, machine A also will give the same product. So I have given B, I have acquired A. Both are manufacturing same kind of products. So now commercial substance, is it there or not there? Listen here. Still, we cannot say that transaction lacks commercial substance. Reason: machine B I have given up. Machine B only has a life of 4 years. Machine A has a life of 7 years. So both may manufacture the same kind of product, but A and B are not same, because A ka life is 7 years, B ka life is 4 years. B will live only for 4 years had I continued it, but A is gonna live for entire 7 years period. So obviously my cash flows from A will clearly be higher than the cash flows what I will receive from had I used machine B. Similarly, quality of the product also matters. So you have to take into consideration everything and see whether commercial substance is existing or not. That is the reason the standard will not and did not use the word are the assets similar or dissimilar. That's not the criteria. The criteria what you have to check is the nature, timing of and risk of the cash flows. So instead of telling all that, I simply told cash flows. Okay, anyway. So let's say transaction lacks commercial substance means what? Cash flows from PP acquired or similar to that asset given up. First, I will tell you the second part, that's very easy to understand. So you are telling me that whatever asset you have acquired and whatever asset you have given up, they both have got capability to give you the same kind of cash inflows in future. So what he says, first write the basic entry. PP A you have acquired to asset B. Asset B is already appearing in my books at what value? 10,000. Now that B is going away, definitely B must be cancelled with 10,000. Here I don't have a choice also. For this you don't need AS10. PPA, what the standard says is, anyway future cash flows change is not there. Why to recognize A at some market value, fair value and all? Whatever is the capability of B in terms of cash flows, the capability of A in terms of cash flows is same. So why to get some other amount? Use the same amount. So this also is recognized at 10,000. So basically, you recognize this entry or asset acquired at carrying amount of asset given up. That's the rule. Now, what is the goal here is, you have to ensure that gain or loss is equal to 0. You see here in the above entry, outgoing asset is credited with 10,000. Incoming asset is also debited with 10,000. Because of that, there is no difference. There is no gain, no loss. Sir, what if there was a cash? If cash is paid, another 2,000 rupees. Suppose you paid cash, then what you would have done? What I would have done? PPA to asset P to bank. This is my basic score skeleton entry. In this 2,000 rupees cash I paid, money gone. Asset B has to be cancelled, so I have to credit with 10,000. Now you can only guess, sir. I don't want a gain or loss in this entry. I can't have anything to go to P&L account. So what choice I have? Carrying amount of assets given up, 12,000. Balancing very right. Always here also same thing. Incoming asset should be recognized at balancing figure so that gain or loss will be 0. Sir, what if you received cash? Then also same, sir. I would have recorded cash here, 2,000. The number would not have been there. If let's say 8,000, I would have written. Simple as that. Gain or loss should not be there when the transaction does not have commercial substance. If the transaction is having commercial substance, the PP, whatever you have acquired, is recognized at fair value. Incoming PPE must be recognized at fair value. Fair value means market value. Sir, okay, sir, fair value of what? In that, very important preferences are there. First preference, second preference. First preference is fair value of assets given up. Second priority is fair value of PPE acquired. So you want to record value of A at first preference, fair value of B given up. A must be recorded not at fair value of A. A must be recorded at fair value of asset given up. Sir, why like that? Sir, A ka fair value is available. No, why don't you take A ka fair value? Why are you taking fair value of asset B given up? The reason for that is initial recognition, as discussed earlier, should be done at cost. What is the meaning of cost? What I pay is cost. What did I pay? I gave up machine B. So machine B ka market value. Had you sold it outside, you would have gotten some 12,000 rupees. Instead of selling outside, you exchange machine B for acquiring machine A. So indirectly the cost of machine A is 12,000. Though you know that machine A ka fair value is 13,000. You will not record it 13,000. Because first preference is always cost. Suppose you tell me I do not know the market value, say second hand asset, how will I know market value reliably? You do not know, fine, take 13,000. Like that. So the entry, how will it look now? The entry will look like this. PPA, account debit, 12,000. 2. What is 12,000? 12,000 is fair value of asset B given up. 2. Asset B from our books we have to cancel. To remove anything, you have to credit that amount with carrying amount. You see the entry is not tallying. This will go to your profit and loss account. This is clearly gain on exchange. Loss also is possible. Here gain has come. Now, if you tell me that, sir, what if cash is paid another 1,000? That means you acquired A by giving away B also, plus another 1,000 rupees cash also you have paid. In that case, it must be recorded at what value? So, logic is same. First, always, sir, write the skeleton entry first. PPA. One line I am leaving, loss may come. Will not come in this case, but still. To asset B. Since I am paying cash to bank. What I very well know is, I am paying 1,000, so I have to credit 1,000. Asset B I am giving up, so asset B ka carrying amount I have to cancel, which is 10,000. Asset A is a new asset which I have acquired. This must be recognized at fair value of B given up plus cash paid. Fair value of assets given up. Assets. So B also, cash also. What is the fair value of B? 12,000. Cash paid 1,000. Total this will be recorded at 13,000. E gap is gain on exchange. That anyway I will transfer it to profit and loss account. Well guys, that is that. This is all about exchange, sir. So now you see once again, how did we start? You gave up one asset, you received another asset. All you have to check is the asset ka cash flow ability, the amount of cash flows what you are going to get in future are the same or not same. If the cash flows are not same, then commercial substance exists. Since cash flows are not same, I cannot record A at book value of B. A ka value separately you have to work out. How? Based on fair value. Fair value of what? Is first preference. Fair value of asset given up or fair value of asset acquired, whichever is more reliably measurable. That's all. If any cash is paid, you pay. But if you say that the transaction lacks commercial substance, the transaction is lacking commercial substance, then indirectly you are saying that the asset what you have acquired and the asset what you have given up, they both are similar in terms of their ability to generate cash inflows. Therefore, the asset acquired must be recognized at carrying amount of asset given up in such a way that the gain or loss in the exchange transaction is 0. Are we clear here, sir? So any cash is paid, you pay. If any cash is received, you receive. I don't mind. But gain or loss must be 0. When gain or loss must be 0? When the transaction does not have a commercial substance. So well guys, with that we have done with our concepts on initial recognition and measurement of PP. We have covered a ready-made asset acquired for cash or credit. We have covered self-constructed PP, and third one we have also covered PP acquired by way of exchange of other assets along with cash or without cash. Both are over for us. Now there are few special cases in the study material. We'll just go through it. Out of the 4 special cases, 2 are kind of useless only. So 4 special cases are given, sir. In that, let's come with the last one. Government grant related to PP. So for example, you purchased a solar power plant. Since you are manufacturing power using solar energy, government wants to give you an incentive. So they give a grant to you. So your cost of the asset is 100 crores. Government gave you some 20 crores grant or a subsidy. A grant ka treatment how to do? For that there is a separate standard. It's called as government grant accounting, AS12. So when we go to AS12, we'll talk about that. So timing, there's nothing for you to learn. Next, PP held by lessee under finance lease. So for example, you have taken a plant and machinery, but you didn't buy it. You acquired it under a lease. So somebody is the owner. You acquired the asset from that fellow on payment of annual or semi-annual rent. So on rent basis you have acquired. Now this asset, how will you record? For that another specific standard is there called as AS19. Lease standard, we will see how to do accounting of a finance lease and all. So timing, nothing to worry. Next. PP purchased at a consolidated price. Now what is the meaning of this consolidated price is? Watch this small example, you will understand. On this also you don't have any questions, sir, but just whatever work it is, I am just telling you. Suppose, sir, you purchased a plant, you purchased a building, then you purchase some stock, you purchase some investments, and you got certain debtors also. All of this you got in a single transaction for a lump sum cost of 10,000 rupees. So all 5 assets you purchased as a package for an amount of 10,000 rupees. In this plant is a PP. The building is also a PP. Now on these two, obviously our current standard AS10 applies. Now at what value should I recognize plant and building? Because I do not know the value of plant and building. No, I purchased 5 items in a lump sum. So on a consolidated level, I know the price. But only plant and building accounting have to do separately. Plant and building will be governed by one standard. Stock is governed by another standard. Investment is governed by another standard. So regarding the plant and building, at what rate I should record? For that, the standard gives an idea like this. What it says is, go and work out the fair values of each item. What is the meaning of fair value? E asset, if you sell off in the market, how much will you get? Plant, building, stock, investment data individually. So let's say, if I sell off the plant and building, plant, I'll get 3,000. If I sell off the building, I'll get, let's say, 2,000. Stock, if I sell, I'll get 4,000. Investment, if I sell, I will get 2,000. Debtors, if I sell, let's say, I'll get another 2,000. So total on all, if you see, the overall fair value of the items what I've acquired is 13,000 rupees, which means 3 plus 5, 5 plus 4, 9, 9 plus 2, 11, 11 plus 2, 13. Now, in this ratio, you allocate this. Meaning, regarding this plant, its number should be, if 13,000 fair value is having a cost of 10,000, then in that 3,000 rupees fair value should have how much cost? Cross multiply. 3,000 into 10,000 by 13,000. How much is the proportionate cost? So if you work out, that's coming to 2308. Similarly, 2,000 should have how much proportionate cost? So 2,000 divided by 13,000 into 10,000. It's 1539. Rest of it also similarly you can work out, but I'm not interested because we want to work out only PP. So first you do proportionately you have to work out on the ratio of fair values. That's what you have to remember. So out of 4 special cases, 3 we have to answer. Now coming to the last one. On this actually a good case, but surprisingly there are no good questions on this in the study mat and all. But you never know, sir. Something can new pop up directly in the exam as well. So deferred settlement terms. Understand this. It's an easy one, also an interesting one. Suppose, sir, I am A Limited. Okay, this fellow is a vendor of machinery. He is having this machine. I asked him, what's the price of this machine? He says, the machine you can take it at a cash price of rupees 1 lakh. Pay 1 lakh, machine is yours. I said, sir, I don't have money, sir. Can't you give me credit? Vendor says, fine, you look like a very innocent guy. I'll give you a credit of 3 months. Go. Sir, after 3 months, how much I have to pay? No, you don't have to pay anything extra. After 3 months also, you still have to pay only 1 lakh. So enjoy the credit period of 3 months. That's what vendor is giving me. Then I say, sir, I want little more credit period. The vendor is asking, how much more? 4 months. No, sir, I want 3 years. Oh. The vendor says, sir, you are asking a credit period of 3 years. Now, when you are asking a credit period of 3 years, vendor has got 2 choices. Choice 1, he'll ask you to get out. Or he'll say, if I give you a credit of 3 years to you, I'm losing interest income. So you compensate me for the interest. Then I'll give you a credit period of entire 3 years. I don't have a problem. In that case, what will happen? Agreed amount is equal to 1,33,100 payable at the end of year 3. You can very clearly understand that if you pay right now, you have to pay only 1 lakh. But if you pay after 3 years, the vendor is losing his money for a period of 3 years. After 3 years, you are giving. So you have to compensate not only 1 lakh, even for the interest also. So he charged interest rate of 10%. You can also count and check 1 lakh plus 10% plus 10% plus 10%. It will come to 1,33,100. Now, if you are A Limited, what entry will you write for this transaction? You purchase the machinery right now. So your entry will be machinery account debit to vendor with an amount of 1 lakh and 1 lakh. You have to record this only at cash price. Or sometimes cash price will not be directly given to you. In that case, you will use present value. What is present value? See, cash price is something I have given. Since I have given, you know the cash price 1 lakh. Suppose, imagine I did not give you this, but I gave you this and I gave you this. Using 133,100 and 10%, you will be able to cook 1 lakh or whatever number comes. So 1,33,100, discount it by 3 years. That will also give you 1 lakh. Depending on the question, can present it anyway. So directly they can give you cash price sometimes. Sometimes they'll give you only the future payment and the discounting rate. Somehow you work out the present value. My entire objective is in this no interest is included. You just have to ensure that in this number and in this number, interest should not be included. Sir, why interest should not be included? I'm paying interest. No, I'm not saying do not pay interest. You pay interest. Don't call it as asset, because interest is a cost of financing, sir. For enjoying somebody's money for a period of 3 years, you are paying some cost. How is that increasing the value of an asset? And moreover, your asset is not a qualifying asset to load interest into it. It's a ready-made asset. So interest cannot be part of the cost of the asset. Just remember that. So machinery account debit to vendor. Now, so now that we recorded this asset at cash price or present value, which is excluding the interest, hereafter what will happen? Now earlier, like how we have discussed for decommissioning liability, PV of decommission cost we recognized as a liability everywhere we did unwinding of discount. No, like that only on this vendor account also, every year you have to record interest expense, and since you don't technically pay anything to the vendor every year, you just record the entry. So 1 lakh into 10%, because initial liability is recognized at 1 lakh, on that 1 lakh 10%, so that would be equal to 10,000 rupees. So the closing balance of the liability is 1,10,000. So on that 1,10,000, 10%. So that will be 11,000. So the closing balance would be 1,21,000. On this 121,000, it will be 12,100. If you count the vendor liability now, it will be exactly equal to 1,33,100. And now I go and pay money to this guy, the promised amount. The moment I pay this balance becomes 0. So this is how you do, sir. You want asset and liability both getting recorded excluding interest. See, when I take a loan, on that loan I have to pay interest, true, but interest is not due on the first day. So that's the reason interest cannot enter into my loan amount. And since asset is not a qualifying asset, interest cannot enter into asset account also. So neither the asset nor the liability should have interest on the first day. So I agreed to pay 1,33,100. In this 33,100 rupees is interest. That cannot go to asset, that cannot go to liability. It is directly going into P&L account as an expense. You can watch this. The total of this and this will be your 33,100 rupees. That cannot come to your asset cost, that cannot come to your liability value. It has to be booked as an expenditure directly in your P&L account. So this is how you do accounting. On this in your study material there is no questions, sir. So I do have some questions with me, but you have all the standards, sir. So too many questions will be too much for you. So we can only do so much which are absolutely necessary for your exam. Okay, now we will pick up some questions, sir. Most of the questions are straightforward, easy only. So let's see the first one. On 1st April 20X1, XYZ Limited acquired a machine under the following terms. List price of the machine is given as 80 lakhs. Quoted price. Import duty 5 lakhs. Delivery fees given 1 lakh. Import duty, usually you will not get any input tax credit, so that's a non-refundable tax. You have to capitalize that one. And regarding regarding delivery fees, of course, transport charges we need to capitalize. Installation expenses, yes. Pre-production testing means a trial run cost that you have to capitalize. Purchase of a 5-year maintenance contract with the vendor. No, sir. Maintenance cost is something which you will incur after the asset is ready for usage for regular maintenance. So this has got nothing to do with the construction or acquisition of the asset. This is just an expense incurred to maintain the asset in the running condition. So this cannot be capitalized. Okay, the dual printed, leave this one. In addition to the above information, XYZ Limited was granted a trade discount of 10% on the initial list price. That means you need not even pay 80 lakhs, you have to pay 80 lakhs minus 10%. 80 lakhs minus 10% if you do, you will get 72 lakhs. And a settlement discount of 5% if payment for the machine was received within 1 month of purchase. What is this one? This is called as cash discount. If you pay the amount very quickly, they will give you another 5%. So outrightly you have to pay 72 lakhs only, but if you pay quickly, then they will give you another 5% on 72 lakhs. And actually you paid also. April 20th you paid off, even though you purchased the asset on 1st April. Within 20 days only you paid off, even though you could have gotten discount even if you pay within 30 days, 20 days you paid off. You actually got the discount also, but that discount cannot be reduced from the cost of the asset. That is not a trade discount, that is a cash discount. It's a reduction in your liability, it's a gain income in your P&L account. At what cost the asset will be recognized? So list price minus trade discount 72 lakhs, import duty 5 lakhs you have to take, delivery fees 1 lakh you have to take, electrical installation charges 10 lakhs you have to record, pre-production testing, yes, you have to capitalize that also 4 lakhs, this no. So if you total up here, so 72 plus 5, 77, 77 plus 1, 76, 77, 78, sorry, 78 plus 10, 88, 88 plus 4, 92 lakhs. 92 lakhs is the value. And whatever cash discount you are enjoying by paying early, that cash discount is a gain for you. You need not pay a liability of 72 lakhs, you have to pay lesser by 3,60,000. So that gain directly will enter into your P&L account as an income. 3,60,000 is to be recognized as income. It cannot be reduced from the cost of the asset. Next one, second question. Excel Limited started construction of a building for its own usage on 1st April 20X0. The following costs are incurred. Purchase price of land, of course, will capitalize. Stamp duty, legal fees, yes. Architect fees, designing fees, guys, that also have to capitalize. Site preparation cost we have to capitalize. Materials you have to capitalize. Direct labor cost also have to capitalize. General overheads, no. See the name itself. General overheads means these overhead costs you would have incurred anyway, whether or not construction of this asset is happening. They are general overheads. Just because you are also one cost center, they allocated something like how you do in your costing, service center cost or something will be there, no, like that. Cannot be capitalized. So everything is looking so straightforward. Material costing 1 lakh had been spoiled and therefore wasted, and another 1,50,000 was spent on account of a faulty design work. So out of your total material cost, which is 10 lakhs, 1 lakh to 1 lakh 50 both cannot be capitalized. One is wasted, another 1 lakh 50,000 is abnormal loss. Total 2 lakh 50,000 loss. So here you can capitalize only 7 lakh 50,000 out of 10 lakhs. As a result of these problems, the work on the building was stopped for 2 weeks during November, and it's estimated that 22,000 rupees of the labor cost relate to that period. So for 2 weeks work halted, and during that halt period also you have to pay the labor charges. So in that 4 lakhs also 22,000 is abnormal loss. You cannot capitalize that. You paid but work is not happening. That kind of cost is a loss for us. Losses cannot be capitalized. So labor cost you can capitalize only to the extent of 3,78,000. If 1 lakh nothing can be capitalized. The building is completed on 1st of January 20x1. When did you start, Ma? You started on 1st April and you finished off on 1st of January. Within 9 months, the project is completed and brought into use on 1st of April. Okay. Excel Limited has taken a loan of 40 lakhs on 1st April 20x0 year beginning for the construction of a building. The loan carried an interest rate of 8% per annum and is repayable on 1st April 20x2. So indirectly now he is saying that a building you have constructed using borrowed funds, and now that this is not a ready-made building, it's a constructed building, it is taking some time also. Now 40 lakhs loan into 8% interest. This is for full year, but my construction period is only for a period of 9 months, April to January or 1st January or April to December ending. So if I do the math, 4 lakhs into 8% into 9 by 12, so that comes to 24,000. 40 lakhs into 8% into 9 by 12. Correct only. 2,40,000. So 2,40,000. The question is, 2,40,000 can I capitalize or not? Now you see, guys, 2,40,000 you can add it to the cost of the asset if you assume that this cost, this plant and machinery or the building, whatever you are constructing, that is a qualifying asset. If it's a qualifying asset, definitely you can capitalize. If it is not a qualifying asset, we will not capitalize. So the question did not say anything. Since the question did not say anything, you write an assumption and accordingly decide whether you will capitalize or not. Write an assumption. You can take any assumption. In the answer printed down there, I have assumed that it is not a qualifying asset and therefore I capitalize nil. But this is not the only answer. You can also assume that it is a qualifying asset and you can capitalize 2,40,000 also. There's nothing wrong in that. Next. Preet Limited intends to set up a steel plant for which it has acquired a dilapidated factory having an area of 5,000 acres at a cost of 60,000 rupees per acre. So you want to set up a steel manufacturing plant. For that you have acquired a land. On that land already some factory is there in a very bad condition. A factory will demolish and you will construct whatever steel plant you want. So now 5,000 acres into 60,000 per acre. How much is this costing us? Is 30 crores, sir. So cost of the land is 30 crores, or in lakhs if you want to write 30 crores into 100, 3,000 lakhs. Okay. Then a sum of rupees 63 lakhs was realized from the sale of material salvaged from the site. One existing building you have demolished it. Since you have demolished the existing machine, sorry, one more line I have missed. Preet Limited has incurred 1.1 crore on demolishing the factory building thereon. Existing factory you demolished. So this only we call it a site preparation cost. 1.1 crore. So 1.1 crore you have incurred. Fantastic. But 63 lakh rupees money came back to you because existing building lo whatever scrap is there you sold up. But the entire 63 lakhs again is not yours. In that 63 lakhs also something belongs to government because GST also you collected. So since that is given in lakhs, what am I trying to do is 1.10 crores, I'm calling it as 110 lakhs minus 63 lakhs I realized along with GST. So this is 1 plus 0.05 or let's say 105. I want how much is 100. 63 lakhs is inclusive of 5% GST. 5% is not meant, government auntie will take away that. A remaining 100 only belongs to me. So in lakhs, if I should solve, so 63 divided by 105 into 100 is 60. 110 minus 60 is 50 lakhs. So this is my net cost on this site preparation. Moving on. Preet Limited incurred stamp duty and registration charges of 7% of land value. Okay, so there is stamp duty and registration charges. 3000 lakhs into 7%. 210 lakhs, that is. Next, consultancy fees of 8 lakhs. You have to capitalize that also. And there is some 1,25,000 on title guarantee insurance. He's asking what is the value of the entire land what I have acquired. So what is there? Add up everything. 3,000 plus 50 plus 210 lakhs plus 8 lakhs plus 1.25. You are having 3269.25. Having 3269.25. This is in lakhs. You can do it in crores also. It will run into decimals. So I just converted everything into lakhs. Fourth question, we need some more knowledge to do this, sir. We will handle it later on. Fifth one is a cheap one. We can finish it off. Omega Limited contracted with a supplier to purchase a machinery which is to be installed in one of the department in 3 months' time. Special foundations are required for the machinery which were to be prepared within the supply lead time. The cost of site preparation and laying foundations is 1,40,000. So 1,40,000 site preparation cost definitely have to capitalize. Just now we have seen also. These activities are supervised by a technician during the entire period who is employed for this purpose at the rate of 45,000 rupees per month. So to do this entire site work, we appointed a technician. That fellow's salary is 45,000 rupees per month. Now how many months ka salary you have to capitalize is your installation period is 3 months. So 45,000 into 3 months, 1,35,000 will come that you have to capitalize. And now the machine is purchased at 158 lakhs. 50,000 rupees transportation charges are also incurred to bring the machine to its factory site. An architect was appointed at a fees of 30,000 to supervise machinery installation at the factory site. Of course, supervision charges also. You will capitalize this. You are required to ascertain the amount at which machinery should be capitalized. No, sir. In this sum, there is no twist at all only. Every number you are able to see in the question, go and add everything. Answer is correct. 1,40,000 you have to capitalize site preparation. 45,000 technician ka cost. If that fellow is not there, site preparation will not happen. So you have to capitalize that. Machine ka cost, main cost that you have to capitalize. Machine has to be brought into our factory. So transportation cost. 30,000 supervision, professional supervision. 30,000. So whatever is given in the question, every number if you add up, the answer is over. Now, question number 6. This is based on the concept of exchange of assets. Now you see, sir, the questions what we have solved till now, you bought a ready-made asset, to that what all we can capitalize. That is one type of question. Then you are constructing an asset, in that what all you can capitalize. 9 months construction period, we have seen that. Now we are talking about exchange of assets question. Entity A exchanges land with a book value of 10 lakhs for cash of 20 lakhs and plant and machinery valued at 25 lakhs. Oh wow. So question number 6, if I should show you, if you are entity A, see what are you getting? Exchanges land with a book value of 10 lakhs. So you gave up land. You gave up land whose carrying amount is 10 lakhs. Book value. In return, you received cash also, you received some plant also. Cash 20 lakhs. Now plant value is 25 lakhs. What will be the measurement of cost of the assets received? Consider that the transaction has a commercial substance. The question itself is telling that the transaction has got a commercial substance. Now one thing observe. What you are giving is land. What you are acquiring is plant and machinery. Absolutely dissimilar assets. Even if the question does not say that the transaction is having commercial substance specifically, still the transaction is having commercial substance is what you have to issue. Now that the transaction is having a commercial substance, the incoming asset must be recognized at fair value. Now, fair value of what? First preference. Fair value of assets given up. What am I giving up? Land I am giving. Land ka fair value is not given in the question. Whatever 10 lakhs they gave you, the land ka book value, not land ka fair value. So I do not have info about fair value of land given up. Since you do not have the fair value of land given up, plant and machinery, whatever you have acquired, must be recognized at its fair value. That means fair value of the plant. Second preference. So first, if I should write the skeleton entry, it look like this. What am I acquiring? Cash. What am I acquiring? Plant. What am I giving up? Land. In this, there is absolutely no uncertainty for this. If you are receiving 20 lakhs cash, you are receiving that. That's all over. Land you are giving away, so land should die in my account, in my books of accounts. Land is having debit balance of 10 lakhs. Naturally, to remove that land, I have to credit land account with 10 lakhs. Gone. Now, the only thing is, if plant must be recognized at what value? So, plant ka fair value is given to you. That's it. The entry does not tally now. Whatever gap is there, that is gain, which will be recognized in P&L account. So, how much gain is there? 35 lakh rupees gain. Next question ka answer services. Next. Pluto Limited owns land and building which is carried in its balance sheet at an aggregate carrying amount of 10 million. So land is there already. This land has a fair value of 15 million. Now this time land ka not only book value, fair value also is given. It exchanges the land and building for a private jet which has a fair value of 19 million and also pays additional 3 million in cash. Oh wow. This time the exchange pattern is different, sir. See, what you have given is land. What you have given is cash. What you are acquiring is a private jet. Very clearly, the cash flows from private jet will be different from the cash flows from land given up. So definitely the question need not even tell you. Commercial substance exists. Now that commercial substance exists, the incoming asset, means this fellow, will be recognized at fair value of assets given up, which is equal to fair value of land given up plus cash paid. Fair value of land given up is given in the question as 15 million. Cash paid, you have paid a cash of 3 million, which means the incoming private jet must be recognized at 18 million rupees in your books, even though the fair value of the private jet specifically is 19 million. PP acquired must be recognized at fair value of assets given up as first priority. If that is not there or not reliably measurable, then only will take the fair value of private jet acquired. Be very, very careful in this. So, my entry will look like this now. Private jet PP 18 million. To bank, I am paying a cash of 3 million. To I am giving my land and building. Careful, don't write 15 million here. This is wrong. Land and building in our books is appearing at what value? Land and building in our books is appearing at 10 million. You have to remove land and building from your books of accounts. So land and building must be eliminated at its book value. Be very careful with that. Entry does not tally. This 5 million will go off to your profit and loss account. A good question. So it can be asked as a small MCQ or a small 4-mark question also. The question I picked up from CA Final Study Material in day 16. Of course, principle is same. You can call it as AST. Next, point number 8. Entity X has a warehouse which is closer to the factory of Y and vice versa. Observe here story carefully. Warehouse means what, sir? It's a godown. I have a factory, I have a godown. Similarly, some other Y entity is there. They are also having factory. They are also having a godown, warehouse. The thing is, their warehouse is closer to my factory. My warehouse is closer to their factory. Okay. The factories are located in the same vicinity. That means it's not like my factory is in one city, that fellow's factory is another city. No. We both are in the same area only, but my factory is closer to their godown and their factory is closer to my godown. And now entity X and Y agree to exchange their warehouses. The carrying value of the warehouse of entity X is 1 lakh and its fair value is 1,25,000. It exchanges its warehouse with that of entity Y, whose fair value is also given 1,20,000. It also receives cash amounting to 5,000. So when I gave up my godown to him and I took his godown, he paid me another 5,000 rupees also. How should entity X account for the exchange of warehouses? First, you must understand the asset what I am giving up, warehouse, and the asset what I am acquiring, warehouse, they both are same nature, same type asset. Moreover, they are also located in the same area. That means area same, building value also must be same. Building purpose is anyway same. That means what? Whatever cash flows you would have generated with your warehouse, which you are giving up now, more or less the same cash flows you will earn with the warehouse what you are acquiring right now in the process of exchange. That means there won't be any significant difference in the cash flows earned from warehouse given up versus warehouse acquired. That means this transaction lacks commercial substance. When the transaction is lacking commercial substance, you are not supposed to use fair values anywhere in your entry. So these numbers are traps, sir. This is a trap. This is also a trap. Then I should recognize at what value? Number 8. Warehouse, new, whatever you have acquired. You are receiving cash also. So bank, warehouse, given up. So here basically you must understand that the transaction lacks commercial substance. The transaction does not have a commercial substance. Now when the transaction does not have commercial substance, you should recognize the incoming asset in such a way that gain or loss on the transaction is 0. Cash you are getting an amount of 5,000. So this incoming asset is to be recognized at 95,000. This is what his answer is. So like how you got a gain or loss here, like that here gain or loss should not come. The incoming asset should be recognized. Remember, you can by heart this, you can recognize this at balancing figure. This is what we wrote in the concept also. This is what we have discussed also. When the transaction does not have commercial substance, the asset acquired will be measured at the WDV of assets given up in such a way that gain or loss is nil. Be very, very, very careful. If commercial substance is there, So first preference, fair value of assets given up. Second preference, fair value of asset acquired. Sir, fair value of asset acquired also not there. Fair value of assets given up also not there. Then what should I do? What will you do? Just like this. WDV of the assets given up, you have to record. What choice do you have? Chalo, sir. Sir, we have covered now fairly some concepts. Little more we will do for today's session. Okay, now coming to sixth point. Subsequent expenditure incurred on PP. Now, what is the meaning of the subsequent expenditure incurred on PP is? So, imagine, sir. So, okay. Sir, I purchased one building, sir, 5 years back. I've been using it. I'm charging depreciation also. Now, lot of students are attending our institute. My building is totally full. Now, I started constructing another floor so that I can accommodate another 300 students capacity there. Now, the cost of this, whatever I'm incurring, let's say some 40 lakh rupees cost, should I add it to the cost of existing building up, or should I book it up as an expenditure in the P&L account? That's a discussion. So this is called as the concept of subsequent expenditure on PP. For that, the answer is like this. Now, you're incurring more expenses. When you're incurring more expenses, is this extra expenditure going to result in extra benefits in future? Because yes, because I incur extra cost, I construct additional floor, my seating capacity increases, I can make more students sit in a class, I can earn more revenue. So that means whatever extra expenditure I'm incurring, that is capable of converting into additional cash flows in the future. So this is basically a capital expenditure. Therefore, this is capitalized. Next, another example. Suppose due to heavy seasonal rains, a portion of the wall got damaged. So what I had to incur, what I had to do is, I have to incur some expenses of 3 lakh rupees and repair this. If you incur 3 lakh rupees to repair a wall, is it going to result into additional future economic benefits, or this is an expenditure incurred to maintain the asset in its existing condition? This is an expenditure incurred to maintain the asset in its existing condition. This expenditure will not give us any additional benefits. Whatever benefits we are anyway going to get, the expenditure will ensure that there is no disturbance for that. So this kind of expenditure cannot be capitalized. This kind of expenditure is thrown off as a expense into P&L. See, whether it is at 40 lakhs, whether it is 3 lakhs, try to visualize in a journal entry. We will record to bank. Now, the debit portion, if you say capitalized, I will go and add it to PP. If you say do not capitalize, sir, let's put it off into P&L account. I will simply call it as expense. So, this 40 lakhs I am capitalizing. If 3 lakhs I am not capitalizing. So, this portion, whatever I am not capitalizing, this will be going to my P&L account. This will be capitalized. Debit is common. Whether are you debiting to the asset or you debiting to the P&L account ultimately is a discussion, sir. This is about subsequent expenditure concept. Next, a very important, a very interesting concept called as component accounting. Now, component accounting concept is like this, sir. Suppose there are so many assets which are built of a assembly of various components. Now, the asset may be a single asset, but that asset might have various parts or various components which are having different useful lives. For example, you take a aircraft. This aircraft is a single asset, agreed, but in aircraft only one part is there. No, aircraft is assembly of various components. Now, just for simplicity, understand like this. The major component is body, and another major component is a motor, the engine part of it. Okay, now let's say the aircraft cost is 10 crores. In that, the body cost is 20 crores, the engine cost is 10 crores. Now, the life of this is 20 years, the body. The engine will have a life of, let us say, 5 years only. That means, now aircraft, how will you depreciate? There is a portion which will work for 20 years. There is a portion which will work only for 5 years. How will you depreciate? The standard says, in the balance sheet, you show the asset aircraft as a single asset, no problem. But in your accounts, maintain separate records for each component that's having a different useful life. Body, separate accounting. Engine, separate accounting. Some other turbine, separate accounting. Like that, for each item, maintain separate accounts. Separate subsidiary records you maintain. Balance sheet, you club them, show them as a single aircraft. Okay. Now, therefore, depreciation also is charged, assuming straight line method, 1 crore per annum. Here, depreciation 2 crores per annum. Okay. Now, I want you to visualize balance sheet at the end of year 4. At the end of year 4, my aircraft will appear at what value? See guys, 30 crore is the cost. Every year, 1 crore depreciation plus 2 crores depreciation, total 3 crores depreciation. Like that, 4 years are over, no? So 12 crore depreciation, if I charge, aircraft will be appearing at 18 crores. If you want individual breakup, body will be appearing at 16 crores. Engine carrying amount will be 2 crores. That's all. 16 plus 2 will make up your 18. Okay, sir. Now, actually, my engine will work for 1 more year. What this fellow did, at the end of year 4, the company replaced engine with a latest model costing rupees 14 crores, or let's say 12 crores. So, what you did, from your aircraft, you removed the existing engine, substituted that with a new engine. So, the cost of the new engine is given as 12 crores. Now, what is the treatment of this entire transaction? Now, what I know is aircraft account, aircraft engine, the new one. You spent how much? 12 crores. Definitely, you have to capitalize it. The moment you quote this entry in the balance sheet, new engine will be capitalized. 18 plus 12, it will become 30. You must understand. Your aircraft is not running with 2 engines, no. There's only 1 engine. New engine ka cost you capitalize. But old engine, physically you're removing, okay. But accounting point of view, the old engine ka carrying amount is still alive to the extent of 2, and that is included in your 18. That also you have to eliminate. You are not a double engine sarkar like BJP. So you have to remove this 2 crores. Sir, how will I remove, sir? Hey, sir, asset, all assets will have debit balance. To remove that, you got to credit it. So 2 aircraft, old engine, remove this 2 crores. Sir, you created, okay, where is the debit? Now that this is a physical part, I can sell it also, no? Sir, who will buy, sir? Scrap at least I can get, no, sir, the physical tangible item. So if I'm able to sell it, I'll debit bank account with some amount. If I'm not able to sell it, then it's a loss. I'll simply throw this off into P&L account. Now, how much is my loss depends on at what rate I could sell. If you don't sell at all, then bank portion is 0. Entire 2 crores or 2 lakhs, whatever it is, that will come into P&L account as a loss. Of course, if you sell it at more than 2 crores, then it's a gain also possible. So this is the story of component accounting, sir. Now you see the beauty here. When you have a single asset, but that single asset is an assembly of various parts, major parts, and each of these parts are having a different life. Now how will you depreciate it? The entire drama will be sorted if you start doing accounting on component basis. Each component separate accounting you do. So you have control. Even the balance sheet you show a single asset. Accounting records point of view, I have control on each account. That's how I play the game. So this is about component accounting, sir. It's a very interesting concept. Next important concept for us is major overhaul or inspection cost. Probably this will be the last point for today's session. Now, overhaul or major inspection costs. Now, what is the meaning of this overhaul or major inspection cost? Imagine, sir, same. You can take any example. Let's take the same aeroplane example, whatever I've used before. Suppose, sir, I have an aeroplane. The aeroplane I have been using for my providing services, carrier services for a period of 5 years. Rules say that once I have used this aeroplane for a period of 5 years, I have to bring the aeroplane back and go and do a detailed testing once again of each and every part to see whether it is fit to fly again or not. You see, sir, once 5 years you have traveled too much, come back, come to a place, we will dismantle the flight. Each part we will check whether it is accurate or not, whether it's functioning well or not. If some replacement is required, we'll do that. We'll do all that. We'll again assemble it. Then what we will do, artificially we create or we simulate the pressure, the turbulence, all that will artificially create. We see how the flight is responding, all the controls are working or not, all the instructions are being given to the passengers or not. All this we will check. Whether the instruction of a turbulence or a flight losing control information is passed on to the authorities or not, everything they will check. Okay. Once they check everything, they will give a fitness certificate if flight is fit to travel again. Okay. This entire drama is called as major overhaul cost. This is not a simple repair or something. This is much beyond that. Major overhaul cost. Now, what the standard says is, whenever you incur major overhaul cost, this needs to be capitalized to the cost of people. Sir, why should I capitalize this? Simple, if you don't incur, you are not allowed to fly again. It's like you are testing the condition of the asset to be used again. So if this cost you don't incur, you are not fit to fly again. So that's the reason it's a direct relevant cost for functioning of the asset. That's the reason we will capitalize this. Now again, one more example. Let's say you have purchased an aircraft for 30 crores. This aircraft, I am making it into 3 parts. Sir, earlier you made into 2 parts only, body and engine. This time I evolved. One is the body, one is the engine, one is overhaul cost. Now, let's say my 3 parts are, let's say this is 15 crores, engine cost is 10C, this is 5 crores. Now coming to the life, for convenience I am assuming 15 years here, 5 years I am assuming here, and 5 years I am assuming here, which means the depreciation will be 1 crore, 2 crore and 1 crore. Here also 1 crore per annum, here also 1 crore. Straight line method, simple. Now, sir, again, just like previous sum, I want you to visualize your balance sheet at the end of year 4 again. In your balance sheet, aircraft which you purchase for 30, every year 4 crores depreciation you are charging, till now 4 years is over. So aircraft would be appearing at 14. So this, in this breakup if you want, body, every year 1 crore you are charging, 15 crores, 1 crore, 4 crores you removed, so it will be 11 crores. Engine, every year 2 crores you are charging, 4 years 8 crores you would have depreciated it, remaining 2 crores. Overhaul cost, every year 1 crore, till now 4 crores you would have removed out of 5 crores. So overhaul cost component is 1 crore. So 11 plus 2 plus 1, total is 14. Number is tallied. Perfect, sir. Now At end of year 4, company incurred major overhaul expenses of rupees 8 crores. Another 8 crore rupees you have incurred now. Sir, why did you incur now? You have to incur after one more year now. True. Imagine, sir. My general policy is to incur overall cost once in every 5 years. But recently in the market, one flight has collapsed. That created a sense of panic among the passengers. What are these flight companies doing? Don't they know how to check? A lot of media cries there. So what I have done is I changed my policy. We have adopted a policy of overhauling the asset more frequently. Instead of 5 years, we changed our policy into 4 years. Because of that, just now I incurred. So now that you have incurred, the entry what you will record is aircraft overhaul cost component 8 crores debit to bank. The moment you write this 8 crores, immediately new overhaul cost 8 crores you have to add. Okay. Now, this would mean that, see, if you are incurring a new overhaul cost right now, what does it imply? It indirectly means that whatever old overhaul cost is there, our old overhaul cost ka benefit is already exhausted. No. So that means 1 crore rupees you have to eliminate now. So what you have to do to reduce the balance of the asset? Overhaul cost. This is new. This is old. How much is there? 1 crore. Earlier also component you removed. Like when you replaced a component, new component ka cost you have added. Old component ka carrying amount you have removed. Like that, you old overhaul cost component also you have to de-recognize it because new overhaul cost you have incurred. But this one you can't sell it, because this is not a physical component. So this one, you can't write bank and all. This is a loss. Directly, you will debit this off to P&L account. The moment you do this, here -1. Old overhaul cost de-recognized. Number is correct only, 1421, sorry. Fantastic. So that's how you do it, sir. Now earlier also you see old aircraft engine, we removed it. When you remove it, of course, in the balance sheet also, old engine ka carrying amount, number 2 is there, no, that you have to eliminate it. So that will make it 28. Make it 28, like that. So component accounting, whatever we learnt in component accounting, that component accounting concept you have to apply and drag it even into inspection cost, major overall cost also. In this, one more beautiful point is there. Now, what did the standard says? When you incur overall cost, you have to capitalize it. When did you incur here? 8 crores you incurred. So you incurred, you capitalized it, that's okay. But what is this one? On the very first day, when you purchase the aircraft, you have segregated some portion towards overall cost also. Now, will I incur overall cost in the first day? When a brand new asset is there, will I go and dismantle it and see whether every part is functioning or not? No, I will not incur overall cost on the very first day with my own hands. Why? That's a new asset. So who incurred the overall cost? The flight when I bought, it naturally comes with a fitness certificate. That means somebody would have incurred overall cost. Who? The seller, the manufacturer, the vendor. He would have already incurred the cost and he would have given it to me. So when he incurred cost, he would have spent money. That money he will recover from me in the process of this 30 crores. So 30 crores, I am not paying only for the body and engine. I am also paying him to compensate the cost what he has incurred for checking the asset. That means the major inspection cost, whatever the supplier, the vendor, the manufacturer has incurred, for that also I paid 5 crores. So I might not have incurred overall cost with my own hands directly. That fellow incurred and I paid. So that 30 crores initial recognition also, some portion definitely belongs to major overhaul cost or inspection cost. So that is a catch point. Now you see, sir, after 4 years, when you incur overall cost with your own hands, that anyway you will capitalize in that way. Where is big deal in that? That is very obvious, very straightforward. What you must catch is when you buy a new asset that comes with a bloody fitness certificate, so the vendor or the manufacturer would have already incurred that expenditure and he will recover that from you. So you paid that also. So in that 30 crores, some amount is towards that overall cost. You need to segregate that also. And you need to depreciate it separately. So we covered component accounting, we covered overhaul, major overhaul cost also. On these two concepts, two small questions are there. One a very good question, one is a normal question. These questions, if we are done for today, sir. Question number 8 is done. Come to question number 9, a very interesting question. Moon Limited has acquired a heavy machinery at a cost of 100 lakhs with no breakdown of the component part. So you purchase a huge machinery that contains of so many components, but each components ka breakup, each component ka value you do not have. The estimated life is 10 years. At the end of 6th year, one of the major components, the turbine, requires replacement as further maintenance is uneconomical. So you purchased an asset, whose life is 10 years. After using it for 6 years, you say that one of the turbine requires replacement, one of the part. The remainder of the machine is perfect and is expected to last for another 4 years. The cost of the new turbine is 45 lakhs. Very well. Can the cost of new turbine be recognized as an asset? And if so, what treatment should be used? Of course, new turbine you are installing, old turbine you are removing. New turbine cost must be capitalized, old turbine carrying amount must be de-recognized. Assume discounting rate is 5% per annum. Why is he giving you discounting rate 5% per annum? We have to see. Now let's solve this question. It's a very good question. Question number 9. Now cost of the plant is 100 lakhs. Its life is 10 years, but this drama is happening at the end of 6th year. So let's first provide depreciation up to 6 years. So if 100 lakhs divided by 10, if I do, I'll get 1 year ka depreciation. I want 6 years ka depreciation into 6 by 10. So that would be 60 lakhs. So 40 lakhs. This 40 lakhs, this is carrying amount of the plant today. That is at the end of year 6. Okay. To this add the cost of new turbine. What is the cost of new turbine? 45 lakhs minus, you have to de-recognize carrying amount of existing old turbine that you have to remove. If you sort out this number, how much I have to remove, that's how the sum is over. So this is the remaining carrying amount of the asset. So your job in this sum is only to work out this, but at least up to here you should not have doubts, sir. You bought an asset, you removed some depreciation, you purchased a new component, you capitalized it, whatever is the carrying amount of the old component that you have to remove it. So the process up to here it should be fine. Now how to calculate the carrying amount of old turbine? Now old turbine, when did you buy? I never bought the turbine. I purchased the entire machinery. In the turbine is also there. But when you purchase the entire machinery for 100 lakhs, the question is pretty clear that first day you do not have breakdown of the component part. You don't have 100 lakhs. How much is turbine cost? You do not know. You never knew that. Now, how will I identify that now? In this 45 lakhs today, sorry, in that 40 lakhs today, how much is turbine ka carrying amount? If 40 lakhs is carrying amount of entire plant. In that only turbine ka carrying amount I want. Now, how will I get that? For that, one small trick is there. Watch this. First one small example, sir. Then I will take you to the question back again. Imagine a cost of a particular item today is 100. Okay. Market inflation is running at the rate of 10% per annum. So after 1 year, the cost of this will become 110. After 2 years, the cost of this will become 110 plus 10%. 121. plus another 10%. The cost of this item at the end of third year will become 133.1. Now, you can understand with basic common sense that in this 133.10, inflation of 3 years is included at the rate of 10% per annum. Now, if I hide this number from you and I ask you, what is the cost of this item 3 years ago? What is the cost 3 years ago? See, we know the answer 100, sir, but how to calculate 100 if you do not know this? What is there, sir? 100 every year we added 10, 10, 10. Now you deduct 10, 10, 10. If you try that, it will not come. 133.10 minus 10% from the answer again minus 10% from the answer again minus 10%. If you try like that, you are reaching to 97, and this 97 is a wrong answer. You want future value, you add 10%. From future value, when you want to come to present value, you don't deduct 10%, you have to discount it. So, the answer is wrong, sir, here. Second answer, take 133.1 and discount it by 3 years. Multiply with third year ka PV factor or straight away discount it. If you discount it, what will happen? 133.10 divided by 1.1 is equal to that will give you 100. This 100 is your correct answer. Moral of the story. When you know price of something today, you want to know price of the same thing few years back. All you have to do is take the inflation rate and discount it back. If you discount it, then the effect of inflation will be eliminated. So, a concept now that you have understood, we will again come back to the question and apply this. Now, cost of new turbine today is 45 lakhs. Now, cost of new turbine 6 years ago is 45 lakhs divided by 1 plus 0.05, because this question they have given you a discounting rate of 5%. 6 years back you have to discount. So, $45 lakhs divided by 1.05. First year, second year, third year, fourth year, fifth year, sixth year. So, I am having a number of 33,57,969. What is this? It is original cost. That means, a number is what is included in your 100 lakhs figure. First day you purchase the asset for 100 lakhs. Now, in that 100 lakhs, 33 lakhs chiller is there. On this, you did not keep quiet. No, you provided depreciation. Less depreciation for 6 years till now you provided. So 33,57,969. In that 100 lakhs, this is there. No, so this also got depreciated for a period of 6 years. So 20 lakh 14,782 I am taking. This much depreciation you provided already. Remainder 33,57,969 minus 20,14,782. So that will be 13 lakh 43,187 rupees. This is carrying amount of turbine today, and this is included in your 40 lakh rupees, and this is what you need to de-recognize today. Till now you are identifying the amount, now you de-recognize. So here 1343,187. So 3156,813. Yeah, sorry, plus 40 lakhs also is there. My bad. 7156. This is your ultimate answer, sir. That's it. That's all. So this is one very good question on component replacement. There is another question which we will do it in the next session. One more for today's session. So ninth one is one, 10th one. Easy question only. Carefully read. A shipping company is required by law to bring all its ships into dry dock every 5 years for a major inspection and overhaul. Overhaul expenditure might at first sight seem to be repair to the ships, but it's actually a cost incurred to getting the ship back into a seaworthy condition. As such, the cost must be capitalized. This is all the principle of the standard that anyway we know that overall cost must be capitalized. A ship that costed 40 crores with a 20-year life must have a major overhaul every 5 years. The life of the ship is 20 years, but overhaul needs to be done every 5 years once. The estimated cost of the first overhaul is 10 crores. What is this estimated cost of first overhaul? 10 crores. On the very first day after buying the asset, you will immediately not go and do an overhaul. No. So overhaul is already done by the manufacturer or the vendor from whom you purchase the ship. So in that 40 crores, overhaul cost component is 10 crores. So that's what you have to understand. So based on up to what we have studied, if the cost of the ship is 40 crores, in this, major overhaul cost component is 10 crores. The remainder ship cost is 30 crores. Now he says the life of this ship is 20 years. But overall cost you have to incur for every 5 years. So the major overhaul, whatever is already incurred, its benefit will last only for a period of 5 years. So depreciation component is 2 crores per annum. Here depreciation component is 1.5 crores per annum. Okay. He's asking, calculate the depreciation charge for the first 5 years. What is there? So this only. Therefore, total depreciation will be 3.5 crore per annum for first 5 years. The next question is asking carrying amount of the PPE at the end of 5th year. Sir, it's a very simple thing, sir. Now, after 5 years, you apply common sense and see. Your 40 crores, 2 components are there. In that, one component ka life is 5 years. So by the end of 5th year, your overall cost component will become 0. You will be left only with the remainder component. A remainder component, you provided depreciation of 1.5 crores per annum, like that for 5 years. So, carrying amount of the ship after or at year 5 ending is equal to, there are two ways in which you can do 40 crores minus 3.5 crore per annum you are charging, like that for 5 years you charged. So 3.5 into 5, 22.5. This is one way. Or else this only we can present in a different way. In this 22.5 crores, overall cost component, if you see, 10 crore you identified originally. In that, every year 2 crores per annum for a period of 5 years you have written off. So today its value is 0. A 22.5 overall cost is not there. Remainder, if you check, remainder you originally capitalized at 30. On that 1.5 crore per annum you are providing depreciation for a period of 5 years. So 5 into 1.5 is 7.5. 30 minus 7.5 is 22.5. So your carrying amount of the asset today represents only the remainder ship, but not the overall cost. But of course, now that 5 years is over, again you have to spend overall cost. That overall cost I'm going to capitalize it to the cost of the asset, and again we will depreciate that overall cost for another 5 years, and the story continues here. So guys, we are done with this up to 10 questions we have solved, sir, and in regarding the concept part, we are done up to 8th point. Now what is left for us is very important, subsequent measurement of PP. On the balance sheet date, how will you measure? Followed by depreciation, and one or two small concepts of derecognition and impairment compensation. Very simple concepts. So what you kindly do is quickly revise whatever we have studied till now. Tomorrow session will be a fresh session. In that remaining subsequent measurement of PP, disposal of PP, revaluation model, very interesting concepts are left. And then one or two small definitions I need to explain regarding bearer plant and all. With that, is standard will be done. So today, to sum up, we have discussed the definition criteria of PP, recognition criteria of PP, initial measurement of PP. In that initial measurement, again 4 types: ready-made asset acquired for cash or credit, self-constructed PP, PP acquired by way of exchange. Number 4, some special cases we have seen like deferred settlement terms, extra large credit period. You have taken multiple assets purchased for a consolidated price. This kind of stuff we have discussed. Then we learned 2 more concepts: subsequent expenditure incurred on PP, what will we do with that? Component accounting we studied. Major overall cost incurred, what is to be done with that? So guys, that's all guys. I'm signing off for today. Please have a revision of this and get back. Tomorrow we'll finish off remaining portion of the standard, and also finish off the questions on this. Thank you guys.